Welcome to the Elliott Wealth Management Services 2026 Economic Update. This is Christopher Calandra, your host. I'm joined by my co-host, coworker, and good friend, Brett DePasquale. What we want to do is take you through some of the key things we are thinking about and forecasting for the 2026 year. There's a lot going on. We have some great information to share with you. And Brett, are you ready to start?
I'm ready. I have my crystal ball in front of me.
Oh, that's good. I wish I had one. So let's just start by setting the stage on where we've come from and where we're going, sort of at a macro level. Walk us through that.
Yeah, so I think we're at a pretty interesting time. If you always go back and take a look through history, you always hear the term let history be your guide. So what we're taking a look at here is just what the S&P 500's done going all the way back to 1997. And as you can see here, as many people know, the S&P is approaching, if not already at some of its all-time highs. So what we're really looking at and trying to drill down on is determining where do we go from here? So we see some corrections, we see some bumps in the road, but we're really going to focus today on 2026 and some of the facts and the bones that really go into what we see could happen this year.
So I think it's worth noting that sort of our theme, if you will, last year in 2025, it was the trend is your friend. And it's just a catchy phrase that captures, in a simple sense, our thoughts. This year, it's a little wordier, but our thinking revolves around an economic reset and a new economic focus. Can you walk us through what we're thinking about with that term, economic reset and a new economic focus?
Sure. So it seems like everything in the economy to an extent right now is different in a way. So to take a quick step back, 2025, the beginning of last year, we were at all-time highs. We thought things were really expensive then. But now, as we've evolved into 2026, we really see that AI is changing the world. And it's also the current Trump administration's implementation of bringing new investment specifically into that space. And that's causing significant change, within the economy, within our everyday lives, and also within the stock market. So some of the other things that really go into that are tariffs, deregulation. The administration's really big on deregulation, pro-business. They're also really pro-technology, and they're showing that with all the investments coming in from overseas to the United States to really make the AI or tech boom. Um, we're optimistic for more of an economic revitalization, which means that as things continue to evolve, things could even look different than they do now next year. And I'll just finish with Chris. I'll give this credit to you. You put in mind that optimism. The definition is viewing something with new life and new vitality. So I think that's pretty good way to sum up what we're looking at for this year.
I think if you're listening to this, depending on your worldview, your view of the Trump administration, and also depending on where you tend to get your news, this may surprise you or it may not. But what we're looking at is the data and the information and what's actually happening, looking at it unemotionally. The Trump administration is making significant changes. Tariffs, a good example. It caused some turmoil back in April of 2025. The market sold off only to rebound. But this is significant. Artificial intelligence, the changes that we are going to see technologically over the next stretch are profound, and the Trump administration is friendly towards this. So this stuff is very significant, and the US economy is set up, possibly, I'll emphasize possibly, for a significant revitalization. We'll talk about this on the next slide, but even today, I just had sort of on the background a business show that I follow, and there's this gentleman, Charles Casparino, who I've followed for a long time loosely. He was talking about GDP growth in 2026 of like 4.5%. That's the type of economic growth the United States has not seen in a very long time. I don't know if that'll materialize or not. I'm hopeful. I'm optimistic. I could certainly see how that could happen. But even just talking about that in a serious way shows how significant this revitalization theme can be, because that has not been talked about for a very long time, getting to 4.5% GDP growth. So we're optimistic, and let's talk about some of those causes for optimism. We've touched on a few of them already. Maybe you could start, Brett, and talk a little bit about continued earnings growth for U.S. corporations.
Yeah, so obviously with new investment inside of US corporations, companies, new money coming in, lower interest rates, earnings are continuing to grow, which is going to be able to propel them to the next level, also driving up their stock price um, along with that. So I think that's one really to watch. I mean, that's also going to be supported by, and I'm skipping a few here, if you're taking a look at the slide in front of us, that's also going to be supported by the One Big Beautiful Bill that was passed back in July of last year. The tax changes, they're supporting corporate profits, they're helping companies. So I think that's really going to drive that continued earnings growth into this year.
Between the friendly administration towards business, the deregulation, the expectation of lower interest rate cuts, and this innovation around artificial intelligence or AI, it does set up US corporations to continue to earn strong profits and grow revenues, which will do wonders for the economy and should be supportive for the stock market. In terms of GDP, I sort of stepped on my lines, Brett. But the most recent, as of this recording, GDP growth number was the United States growing at 4.3%. Very, very robust. When you look at 2025, it started out slow in the first quarter, but accelerated through the year. Surprised a lot of people. There was tons of forecasts back in the spring of 2025 that we would have a recession. This was a lot of fear mongering regarding the tariffs. None of that materialized. So the economy based on GDP is healthy and growing, accelerating growth. And that is something that we're expecting to continue in 2026. And again, that is a terrific cause for optimism. If the economy could grow at a good clip, at a faster clip than we've seen the last bunch of years during both Trump's first administration as well as during the Biden administration, that will solve a lot of ills. A fast growing economy will solve a lot of things that have people on edge and are worried and helps solve a lot of problems. So we're looking for very good GDP growth, which will be very much welcomed. And related to this is artificial intelligence and technological innovations that we're seeing. And we're not necessarily seeing, Brett, a lot of this necessarily in our day-to-day lives just yet. What's happening, and listeners and viewers ought to appreciate that what's happening is US corporations are investing a lot of money to cultivate this new technology, to create it, and then to implement it. And that's going to be the next phases that you'll see more businesses using it in a more powerful way. And this investment that's being made will continue, but we'll start to see, our opinion is, we'll start to see greater and greater harvesting of the benefits of this investment and this new innovation. And that ties into what we've already talked about. That'll help earnings growth for US corporations and help with accelerating GDP. Did I explain that okay, Brett?
Yeah, I think that's fantastic.
So, talk a little bit about the Trump administration. I mean, we seem to be cheerleading for the Trump administration, and I recognize that some of our clients, some of our followers, some of our potential clients may not be big fans of the Trump administration. In fact, some of you may really, really dislike Donald Trump and his administration. But let's talk a little bit about some of the things that we think the Trump administration is doing and will continue to do that give us cause for optimism in 2026 and beyond.
Yeah, absolutely. And the one thing I will say is what I like to tell people is with our position is to not be blue or red. It's to stay right in the center in the green. So green deals with money. That's what we're looking at. We're looking at the hard facts. We obviously have our own personal opinions, as do our listeners, but it's really important to just note that we're staying right in the middle in that green money area, if you will. But the Trump administration, with passing the tax bill, is going to give some nice relief to families, corporations, some nice tax benefits for business owners as well. I mean, they generally lean more business friendly as it is. I mean, any administration that is more deregulation than regulation is generally more business friendly. So that's a positive for both small business and large business together. Um, Tariffs. So you mentioned the tariff situation back in April, May of last year. A lot of headline driven volatility, but it seems to be they're working. It's bringing in extra money for the country. I know it's a pretty polarizing topic, but at the same time, it's money for the country, and it seems to be paying off to this point.
Yeah, let me dovetail and add that the tariffs, one of the stated purposes of the tariffs was to reset trade policy around the world and also to create an environment where it was more enticing for businesses to onshore manufacturing and operations in the United States. So not only have we created a new income stream, although I'm not exactly sure what we're doing with that money, but that's a side note, is the expectation is, and I think we've only seen a little bit of it, and hopefully we'll see more in 2026, is that US businesses onshore more manufacturing and bring more operations home because there's more incentives to do so. Number one, to avoid the tariffs. And with this friendlier regulatory and tax environment, there's some really nice payoffs if they do it. At least that's the thesis that the Trump administration and Secretary of the Treasury, Scott Bessent, have in mind. And again, that's a cause for optimism. And interest rates were a key topic in 2025. Let's talk a little bit about outlook for interest rate cuts in 2026. And Brett, maybe you could share with me and the rest of us your thoughts. It doesn't seem to me that interest rates are as an important topic going into 2026 as they were in 2023 and 2024. So, how about it?
Yeah, I mean, I think interest rates are still going to be pretty important, but definitely not to the extent of last year. Last year, it was really important for the Fed to show that they were willing to start cutting interest rates again and get them on the right track, moving back downward. So, obviously, if they cut a little bit more this year, I've seen some projections anywhere from half a point all the way up to a full additional point. We'll see. I think it's going to be really dependent on the new Fed chair, how that all shakes out. It'll hurt your high yield savings accounts a little bit, hurt some of your more cash liquid funds. But at the same time, if you flip it around on the other side, it could be very positive for the housing market. A lot of people are sitting on the sidelines, waiting to buy a home as interest rates come back down. Some people also have refinanced their mortgage back in the early 2020 through 2022 timeframe. Maybe they've outgrown the house, but are unable to kind of take advantage of some of that equity and go to something different, both because of housing prices, which that's a conversation in and of itself, but also just waiting for the reprieve of the interest rates to come down, and they don't want to get rid of a 2% mortgage. So really depends on what side of the aisle that you're on, whether you're a buyer or a seller. But I think overall, it's going to be a positive for the housing market, both in supply and also in demand.
Yeah, and to your point, we finished up 2025 with the average 30-year mortgage rate at the lowest point in all of 2025. So seeing that trend continue with declining mortgage rates should be helpful to the housing market, and that's good for the economy overall. And before we get to small cap and value momentum, talk about tax changes supporting corporate profits. I touched on this briefly, but part of the one big beautiful bill allowed for immediate expensing for certain R&D and manufacturing costs. So if a business, let's say, builds a new factory or a new expanding of a factory, like a new wing of the factory or something like that, you used to be able to deduct some of those expenses, but over a period of time. With the one big beautiful bill, you take immediate expensing to that. And that's one of those incentives for businesses to make capital expenditures, to invest in their businesses, because if it makes business sense, you're also going to immediately be able to deduct it. So it's very tax friendly too. And that is meant to, and I believe will, spur some of that onshoring I referred to earlier. Is there anything else with the tax changes supporting corporate profits you want to bring up, Brett?
No, I think it's excellent for purchasing power for companies. And I also think it really lends itself to expanding their operations, their factory, and helps them put out more product and help support the profits.
So, everyone listening and watching, the purpose of this is not to give specific investment advice, but rather sort of a macroeconomic thesis, things that we're thinking about. We're talking about causes for optimism. In a moment, we're going to switch to some things that are worrisome that we want to watch and things that might upend this feeling of positivity. But we did want to share with you all of these causes for optimism also play into a little bit of an investment thesis, a macro thesis that we have. So can you walk everybody through that regarding small caps and values momentum?
Yeah, I think it goes into what we were just speaking about with the new administration, the business friendliness, the deregulation. That's all going to support small business and also small cap different investments. So these smaller companies rely on a good cash flow. They rely on borrowing power. So borrowing power is going to be affected by interest rates as well. So as we see interest rates come down, their borrowing power can go up. Their ability to manufacture more, sell more product also goes up. So we're seeing a good shift down to the small cap space where all the attention lately has been on the large and mega cap space with your big players such as the Magnificent Seven, like Apple, Nvidia, Tesla, all of those companies. So it's a good way to begin to diversify away from some of these large gains in the large cap space over the past few years.
Yeah, it's worth noting as we shift to things we're worried about is small cap stocks and value stocks, by and large, have not performed as well as other sectors. So maybe with this revitalization we're talking about, they may have their moment to flex their muscles, and it might be a decent place to diversify into. So even though we're optimistic and we have this revitalization theme for 2026, as we've already laid out, there are reasons to worry. And some of them are constant. You know, if you go back and look at previous economic updates we did, some of these are sort of perennial, but many of them are specific to what's going on now. So let's walk through those, starting, Brett, with geopolitical unrest.
Yeah, I mean, I think geopolitical unrest, I mean, even at the time of this podcast, is a pretty decent one because we have the ongoing war in Russia and Ukraine, and most recently, we have some military operations in Venezuela. So, with things like that, I think that's also falls under the category of some headline-driven things as well. But anytime you have some unrest like that entering new conflicts, situations, that's always going to affect the market potentially.
Yeah, and there's a lot going on in the world right now, militarily, politically. You know, have discussions about Greenland. We have what occurred in Venezuela earlier this month. You have what happened with the attack on the Iranian nuclear facilities. You have Israeli and Gaza shooting at each other still, uh, or the Palestinians and Israelis shooting at each other in Gaza. You have the Ukraine and Russia war, which incredibly is still going on. So, I mean, there is a lot to go on and a lot going on, and that does offer significant risk. But so far, so good. The next reason to worry is something that I think was a greater focus and worry last year, at least for me, and that is elevated valuations. The stock market historically is on the more expensive side of things. But I have a better case this year compared to last year that with strong corporate earnings and with accelerating GDP growth, that the market could sort of catch up and grow into those valuations. I was candidly more concerned last year going into 2025 as I am now. Nonetheless, this expensive nature of the stock market probably can't continue, meaning that we are actually going to have to grow earnings and grow into these valuations, or perhaps there might be some downside exposure because historically these elevated valuations don't last forever and something will have to give. As we've already outlined, our thesis is that we're more likely to grow into the valuations like we did last year a bit. But it is still a concern with the S&P 500 forward price to earnings ratio somewhere in the 22, 23 range. And then there's also this talk about bubbles. If you watch the financial news or the mainstream news, they like to talk about, is there a bubble? Is there a bubble? So there is a worry that maybe there is a bubble. But even if there isn't a bubble, people talking about a bubble and fearing a bubble may actually manifest something bad happening, almost what's a self-fulfilling prophecy kind of thing. So we don't like that talk. I don't feel like we're in a bubble. Do you, Brett?
I don't think so either.
The thought, if enough people think it and enough people act like it might be there, you could actually have negative consequences, whether there's a bubble or not. So that talk generally, or that fear generally, that is in the public sphere quite a bit, it is a reason to worry. Hopefully, it doesn't manifest itself. Related to the elevated valuations and the bubble concerns is the reality that the market has done well now for 3 consecutive years. 2022, 2023, and 2024. No, I misspoke, right? 2022 is a bad year. 23, 24, and 25 were strong bull years. The thing is, the last couple of years, is there's only been a handful of companies that have really done most of the upside work, and many other companies have sort of languished and not participated. So talk a little bit about why that's a worry, Brett, the narrow breadth of the market.
Yeah, so I mean, we're getting a lot of growth off of very few companies. So if you take a look at the entire S&P 500, like I mentioned before, you have the Mag 7, as they call it. So seven large companies. Everybody knows pretty much all of them, I would assume. Google, Amazon, Apple, Facebook or Meta, Microsoft, Nvidia, and Tesla. So they actually those seven account for about 35% of the total S&P 500's market capitalization. So those seven, 35% of the other 500 companies. That's a really narrow place to go in these, and that's on those seven companies to get your gains off of. So that really narrows where the gains are coming from, and it kind of takes less from the other companies, the other 493, to produce something.
Yeah, I think it's a sign that there's fragility in the S&P 500, that the main performance numbers don't necessarily reflect. If you look at the numbers, they're really good. But when you look under the hood, it seems a little fragile because if those couple of big time winning companies should struggle for whatever reason, uh, what we've seen is there's not necessarily enough other companies, enough other industries to pick up the slack. So it's a reason for worry because this narrow breath hopefully doesn't continue. Because if it does, the market will continue to be more and more fragile. What we'd like to see is a broadening out and more companies get into the winning column and participate, not just the huge winners we've seen the last couple of years. And related to that is headline volatility. So tell us a little bit about what we're thinking about in terms of that worry.
This is when we tell you not to watch the news because it's bad for your health.
Yeah.
I mean, depending on where you watch your news, how you consume your news, whether it's mainstream on cable television or through a podcast source where a lot more people now are receiving their news from ever than ever before. It's really that follow the leader mentality. If you're watching the same broadcast as millions of other people, whether that headline is true, not true, or just to get a rise out of their audience or clicks from their audience, that follow the leader mentality kicks in for people, and that causes volatility in the markets. So rather than using just the facts-based approach and going to trusted sources, some sources will lead you down a path that potentially might not be correct.
And the next one, before we get to the last one, which is my baby, political shifting causes uncertainty. Tell us about that.
Yeah, it's a midterm election year. So anytime you have a midterm election year, historically, growth has been pretty muted. But I'm thinking that it's going to be just the opposite this year. Things seem a little different, and we've covered all the reasons why we think so. But as of right now, the Republicans control the majority in the House and the Senate. So we'll see what happens coming into the fall. See if there's any shifting of that. Maybe one of those two bodies gets shifted the other way. Maybe they both do. So it'll be very interesting to see how that plays out.
It's worth noting that historically, the party out of power makes gains in the mid-year election. So that historical trend means that the Democrats are likely to pick up seats in the House and the Senate. Expectations as of this moment are that the Democrats probably take control of the House. It's less clear about their likelihood of taking over the Senate. But if that happens, you go back to divided government. And if you really like what the Trump administration is doing and you tend to be a Republican voter, you might not like that. If you're more of a Democrat voter, you might like that because you might want to stop the Trump administration. But what we found historically is markets do very well in a divided government environment. So we're not really worried either way. But a change in control of one of the two houses in Congress would change the political landscape, and that would have an impact across most of what we're speaking about. So that's something that we're going to watch. And the last thing before we move on to the next slide is I'm a little paranoid. I started in this business in 1992, right out of college. I've seen a lot of things, and a little paranoia is not necessarily a bad thing. And what I found in preparing this, and this was reinforced by the rest of the team, Brett and Lindy and the others, is that it was easier to come up with reasons for optimism this year than worry. And that in and of itself might be a reason for me to worry. There aren't many reasons to worry, which makes me worried. that might sound like I'm sick in the head, and maybe I am because I'm a little jaded, having gone through many, many different markets, including some incredibly difficult ones. But one of the things that I want to be mindful of, that we will be mindful of, is not to be too rosy in our scenario and to watch for things that we might not have picked up at this moment that might actually upend the apple cart and ruin some of these optimistic vibes we feel with this economic revitalization thesis that we have. So that's my little speech on that subject, Brett.
You're good.
So talk a little bit about Brett, the idea that these winning companies, which we talked about uh, having the wish that we would see more companies participate in. It's not such a narrow market, but talk a little bit about, hey, it's not necessarily a bad thing, these companies that are winning. Touch on that.
Yeah, so when you take a look at some of these winning companies, you really need to look at what they are, what they're doing, and their ability to move forward and scale. So generally, when you're buying a quality company, you're buying a strong balance sheet, you're buying consistent cash flow, and you're buying complete dominance in their area typically. So they're the ones dominating in a space, whether it be semiconductors, technology, whatever it may be. So realistically, when you take a look at a PE ratio of whether it's high or higher than it most likely has been in the past, you're looking at high PE ratios of companies that are asset light. They're software or IP driven. So they're doing things on computers through technology and innovating that way rather than straight goods and services. And being software and IP driven allows them to be highly scalable. So by looking at some of these nice quality companies, important to realize when you're buying them, you are most likely getting what you're paying for.
Yeah, I mean, it's a good point. Just to summarize, the reason why these companies have done so well with their stock prices and they are the leaders in the market and have done incredibly well is because they are powerful, very successful companies. They're innovative, profitable, uh, wonderful prospects for the future. I mean, there is specific reasons why they are doing so well, and that shouldn't be lost on us. Uh, so we touched on the mid-year election. Anything you want to add? I kind of covered that before we wrap up, Brad, about the mid-year elections.
No, I don't think so. I mean, I think we'll see if history repeats itself or not. And then obviously if there is some volatility, we just take a look at managing that risk in and of itself, and then maybe even find some good opportunities in there as well.
So, everyone listening and watching, we appreciate your time. Hopefully, you found this valuable. As you might expect, we put a decent amount of work and thought into prepping this for all of you. It's also very valuable for us because it forces us to focus our attention and hone in what we're thinking about because we get lots of different data points and we read and listen to different things. So, this is a wonderful exercise. What you could expect from us, as always, is a regular review of changes that might affect you. We're going to communicate you. This is an example of that, this economic update. We have the Simply Financial podcast. We have our monthly mailing. You can always reach out to us by email or by phone to talk about changes in your situation, but we want to have regular communications with you, our valued clients. And we are going to continue to review changes and what's going on economically with taxes, estate planning, and other investment issues for our clients so that we can serve you well. So, with that, thank you for listening to the January 2026 economic update from Elliott Wealth Management Services. You've been listening and watching Brett DePasquale and Christopher Calandra. Thank you for your time today.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, You are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.